If I lost everything today and I had to rebuild my property business from scratch, here's exactly how I would do it step by step. Over the last 20 years, I've built over 300 homes and I've learned a lot and made my fair share of mistakes. And if I had to start over again today and guide my younger self, this is the exact 4-step plan I would follow to get back to where I am today. Now, before I get started, if you are someone in the UK and you are interested in starting a property investment business, I'm looking to partner with 5 people to help them do their first deal. You'll be working with me directly and I'll help you every step of the way get your first deal done in the next 90 days. Now, if you're interested, check out the link in the description below and book a call with me. Now, having said that, guys, let's dive in. So, step number 1 is education. Now, this might sound a little cliche, but you need to have the right knowledge and education before you start property investing. Here's the thing. Property investment isn't something you just wing. You can't go into it thinking, okay, I'll figure this out as I go. That's how people end up making costly mistakes. Why? They overpay for properties, they underestimate renovation costs, they buy in areas with no growth potential. These types of mistakes can put you in a serious financial trouble and difficulty. If you don't take the time to understand what you're doing, in essence, you're gambling. And in property investing, the stakes are so high, you can't afford to make those mistakes. So how do you avoid that? You educate yourself. You need to dedicate time to learning the fundamentals before you even think about making your first deal. Now, I'd recommend you give yourself 90 days to learn the fundamentals. Spend an hour a day diving into core areas of property investment. And by the end of that time, you'll be confident and prepared and ready to make your first property deal. Now, let me break it down exactly what you should focus on in those 90 days. So, the first thing you need to know is how to appraise an area. Now, this might not sound like a big deal at first. You'll be thinking, yeah, I know my neighborhood pretty well. How hard can it be? But here's the mistake most beginners make. They buy their first property they see in their neighborhood because it feels familiar. Now, what's the problem with that? Familiarity does not equal opportunity. Just because you know the streets, the coffee shops, and the local parks doesn't mean that's an area as a good investment. What you really need to look at is growth potential. And is the area on the rise? Are businesses moving in? Are new schools being built? Is there demand for rentals or is there a demand for resales? These things are what matters. And it comes at picking a profitable location. You can't just guess. This is where you need to dig into the data. So, how do you learn how to appraise an area? Well, you start with research. Dive into local market reports. Look for areas with rising property prices and a strong rental demand. Check out government development plans. Are there infrastructure projects? New roads, train stations, are there things like that in the works? Are there signs of regeneration, new buildings, renovations, and talk to the locals. Here's one more tip. Build relationships with local agents. These people know their market inside out, and a good agent can give you insights before you'll find any of that online. There's much more that goes into learning professionally how to appraise an area, but those are the basics. These are the foundations. Get it right and you'll be setting yourself up for success from day one. The next thing you need to learn is how to appraise the property. You've got the area, you now need to know how to appraise a property within that area. This is another area where a lot of beginners trip up. They get caught in the excitement of finding a deal, forget the most important question. Does this actually make any financial sense? And let me put it to you this way. Just because a property looks great on the surface, it doesn't necessarily mean it's a good investment. You need to know how to break it down and really understand the numbers. It's not about what it looks like. So what do I mean by appraising a property, and what does that mean? Well, it's about figuring out two key things. How much is the property worth right now, and what could it be worth after you've finished working on it? Either is it going to be a cash flow asset that you keep, or a property you intend to trade. So you start with the following. You get comparables. We call them comps. Look at properties that are the same in the same area, that are the same size, condition, and have the same features. What are they selling for? And what are they renting for? Websites like Rightmove will give you a quick idea, but you don't stop there. You talk to the agents, you get a feel for what the property is worth. Next, you need to run the numbers on your costs and your returns. Things like, how much is it going to cost to renovate or update? What will it cost to maintain that property if I'm renting it? What are the expected rental incomes or the resale values? So here's a quick formula for you to keep in mind. Profit equals future value minus purchase price minus renovation costs and minus professional fees and other expenses. If that number does not look good, you walk away. Look beyond the property itself. Look at the streets, the surrounding homes. A great property on a rundown street is going to be much harder to sell. You may be able to rent it, but it's going to be harder. Learning how to appraise a property is all about due diligence. If you can confidently answer the big questions, what's it worth and what could it be worth and what will it cost to get there, you're already ahead of most beginners. Beginners usually shop on their budget in their neighborhood and they don't analyze things properly. The next thing you need to learn is contracts and negotiations. Right, now I get it. This doesn't sound like the most exciting part of property investment, but let me tell you, if you don't understand the contracts you're signing, you're setting yourself up for trouble. Contracts are everywhere in property. You'll deal with them when you're buying a property, hiring contractors, working with the agents, securing your finance. Everything is about a contract, and they are not forgiving. One missed clause or misunderstanding can cost you thousands. Let's say you're hiring a contractor to renovate your property. If the contract doesn't clearly spell out timelines, costs, and deliverables, you are opening yourself up for delays, budget overruns, miscommunications, and headaches. All of those you don't need. Maybe you're working with an agent and you're buying a property, and if you don't fully understand the terms of that agreement, you might end up paying hidden fees. Let's just say that they're not performing and you want to move on and you appoint another agent. You could end up losing money or even losing the deal because of those kind of maneuvers, because you do not appreciate the terms of exclusivities within the agent's contract. The good news is you don't have to become a legal expert. You just need to know the basics. You need to read everything you sign, which sounds obvious, or understand where the usual pitfalls are going to lie and what they mean. Ask questions if there's something you don't understand and just revert back. Then there's the art of negotiation. Now, negotiation isn't about being aggressive, trying to lowball everybody. It's about finding a deal that works for both sides. When you're buying a property, for example, don't be afraid to ask for price reductions if there are additional repairs. And don't be afraid to ask the vendor to do those repairs if you want them done before you buy the property. The worst case, they can say no. You just need to understand how to present what you're asking for. Understanding the contracts and mastering the negotiation skills that will serve you throughout your property journey is key. They're not just about protecting your investments, they're about giving you control and peace of mind in every deal. Finally, you need to understand financing and leverage. Now, this is where the magic happens, or where things go very, very wrong if you don't know what you're doing. Let me start by saying this. Financing isn't about getting the cheapest mortgage rate that you can find on Go Compare. A lot of beginners think, I'll hop online, I'll compare the rates, I'll grab the lowest one I can find from Halifax or the High Street. But that's not what smart property investors do. Financing and leverage are about using money in a way that helps you grow your portfolio quickly and safely. So what does that mean? It means understanding how much you can borrow without overstretching yourself. It means knowing what kind of loan fits your strategy. And it means figuring out how to structure deals so you can reinvest and withdraw your capital to allow you to scale. Here's an example. Let's say you buy a property, you fix it up, and you increase its value. Now, instead of selling it, you want to refinance it and pull out some of the increased value and equity and use that money to buy your next property. That's it in a nutshell. That's leverage. Now, let's say you want the right finance. Cheapest might mean the lowest interest rate. But what if the lender wants a deposit of 45%? So the cheapest rate is only going to deliver you 55% of the property value, or they're prepared to lend 65% of the property value and you've got to find the rest. You may have to find that deposit. Now, let's then say that you've got to account for your renovation fees. So how does that start to stack? If you want to refurbish the property and you've got the cheapest rate on the market, you may come to a point where you're going to run out of money. Therefore, you need to understand how the capital stack works. But here's the thing. Leverage is a double-edged sword. If you take on too much debt or you don't factor in interest rate hikes, you could find yourself in a tough spot. You also need to stress test. But this is an entire topic revolving around finance, and to properly go into it, it's not something I can do on this particular video, but I will go into more detail in a future video. But here's some of the basics to get you started. First, start by learning what interest-only finance is versus repayment loans. What's the difference between short-term loans and long-term finance? These are things you need to know and get your head around. Then you also need to work with the right people. A good mortgage broker or a financial advisor is worth their weight in gold. You need good people. They can help you find the right products, navigate the market quickly. And finally, always plan for the worst. Always ask yourself, what happens if something goes wrong? I've mentioned interest rates go up, but what happens if the property takes longer to refurb than you expected? What if your refurb costs go up because there's something you haven't factored in? Are you still going to be okay? You need to know how to skin those numbers and present them and cover yourself when you're going to finance. Here's my personal rule. Only use leverage when you have a solid plan of how you'll pay it back. It is a powerful tool, but it is not free money. When you understand financing and leverage, you're not just buying properties, but you're then building a system that works for you and not against you. So what's step 2 after education? Step 2 is finding a mentor. This is probably one of the most underrated steps, but it's also one of the most important. And let me tell you why. When I first started out, I thought I could figure everything out on my own. I read the books, I watched the videos, and I learned as much as I could. But there's only so much that you can learn in isolation. The real turning point of my journey came when I found a mentor. And a mentor isn't just someone who's been successful. There's someone who can show you the ropes and help you avoid the rookie mistakes. And more importantly, they're the person that can open doors for you. You don't even know that those doors exist, but having a mentor is such a game changer. First and foremost, they shorten your learning curve And when you're on your own, you have to figure everything out the hard way with trial and error and bad deals, wasted time and mistakes. And a mentor has already been through that. They've made the mistakes, they've learned the lessons, and you can save from their experiences, right? So number 2, as I say, they'll open doors. A good mentor has those networks. They may know agents, they've got contractors, they know how to deal with contractors. They'll have lenders that they'll understand how those lenders work. And they may have other investors. And if they believe in you, they're going to connect you to those people. Finally, they'll keep you accountable. Property investment isn't always going to be smooth sailing. There will be moments when you feel overwhelmed and unsure, and a mentor can keep you on track, remind you of your goals, and push you to keep going when the going gets tough. So how do you find a mentor? Start looking for someone who's already doing what you want to do. Maybe it's a successful developer, someone in your area, someone who specializes in the same strategy that you're looking to achieve. Reach out to them, be genuine, offer them a coffee and ask for some advice. But here's the key. When you do get the time with a mentor, come prepared. Don't just ask vague questions. How do I get started? Be specific with what challenges you're facing now and what you want to achieve. Also understand that mentoring is a two-way street. You can find ways to provide value to them, maybe helping them with some research or assisting them on a project. Show your worth and build a stronger relationship. Having a mentor doesn't mean you'll never make a mistake, but what it does mean is you'll make fewer of them. And when you do hit a roadblock, you'll have someone in your corner who's been there before and who knows how to get you past it. Step 3 is defining your strategy. Now, this is where a lot of people get stuck, or worse, they try and do everything. Now, let me paint a picture for you. You've just started learning about property investment. You're hearing about flips, buy-to-lets, BRRR, title flips, planning gain, and suddenly all of them sound like a good idea. You're excited and you want to try it all. But here's the problem. If you chase every opportunity, you master none of them, and you spread yourself too thin. And before you know it, you're overwhelmed, you're confused, you're losing money, or you get stuck in analysis paralysis because you don't know which one you're going to follow down. That is why defining your strategy is critical. Pick one lane and just go there. Master it. Once you've nailed it, you can branch out and you can begin to do other things. But focus on becoming an expert in one area first. So how do you pick the right strategy? So ask yourself a few simple questions. What's your end goal? Are you looking for a steady rental income or quick profits or long-term wealth through capital growth? How much time do you have? Some strategies like flips require hands-on involvements. Others like buy-to-let, once you've set them up, are more passive. So what's your tolerance to risk? Are you comfortable taking on bigger projects with higher risk? Or do you prefer something more straightforward? Once you've answered these questions, you'll get a better sense of what strategy fits you. But I'm going to break down a few of the popular strategies. BRRR, buy, refurbish, rent, and refinance, or I call it recycling. This is where you build a portfolio without consistently needing new capital. You buy a property, you renovate it, you increase its value, then you rent it out, and then you refinance to get your capital out to go on to your next deal. Now, if you can do that properly, that's a very, very good strategy, but you need to understand how all of those elements work. Then you have flips. This is about buying a property, fixing up, selling it to make a profit. It's quick, it can be lucrative, but you need to be good at managing costs and time. Then there's title splits. This involves converting one property into multiple units, i.e. turning a larger house into apartments, an office into residential, and converting something into a residential home. It requires knowledge of planning, regulation, but it can significantly increase a property's value if you do it properly. Then there's my favorite, which is planning gains. You take a property without planning permission, you get planning and the necessary approvals, and you sell it for a higher value. The key, it's challenging, but the rewards can be huge. The key here is to pick one strategy and stick with it. Don't get distracted with every shiny opportunity that comes your way. When you focus on one strategy, you build your expertise and you learn the ins and outs, and you get faster and you get better, and you can start seeing results. And when you've mastered that strategy, you can then expand and explore other opportunities. So define your strategy, commit to it, and trust the process. And step 4 is ownership. This is where everything you've been working towards comes together. All the learning, the planning strategy, and the lead down the road leads to this, actually owning the property. Sounds obvious, but let me say this up front. Ownership is what separates successful investors from everybody else. Rent to rent or flipping can make you money in the short term, but owning a property and owning a portfolio is where you build real wealth. And here's why ownership matters. First, you've got capital appreciation of your portfolio or your property over time, and the property values go up generally. Historically, it always has done. And on average, a property doubles in value every 10 to 15 years. When you own the property, you benefit directly from that growth. And then there's the cash flow. If you're renting the property out, it generates a monthly income. Obvious, right? That money comes in whether you're working or you're not working. It's passive. And that then becomes a legacy. And when you own the property, you're not just building the wealth for yourself, you're creating something your family and the future generations can benefit from. Now, here's the thing. Ownership isn't just about buying a property. It's about owning the right property. Not every deal is worth holding on to, and not every property is going to generate you wealth. So how do you decide what you're going to own? Well, first, you look for the potential, the long-term potential. Is this property going to be one that's going to grow in value over time? Is it in an area with strong demand for rentals or sales? And next, you need to run the numbers and make sure the property will give you a positive cash flow. And after all expenses, maintenance, insurance, and so on and so forth. And finally, you've got to think about scalability. Can this property help you grow your portfolio? For example, if you refinance it later on, will you have enough equity to fund your next purchase? Now, here's an important tip. When you're building a property portfolio, focusing on owning the asset, not just controlling it, is key. Strategies like rent to rent or lease options might give you some cash flow, but they don't give you a long-term benefit of ownership. And ownership is about thinking ahead. It's about making a decision today that will pay off tomorrow. When you own an asset, you control it. And if you control it, you're building your wealth on the terms that you dictate, not someone else's. So guys, this would be my 4-step plan to get started in a property investment career if I had to do it again. But what if you're impatient and you want to learn quickly? Check out some of the links below. Property investing is not about getting rich quick. It's about building something sustainable, something that can grow with you over time. The best part about this is none of it is out of your reach. You don't need a huge amount of money to start. You don't need to know everything from day one. You just need to know what the actual key skills are, and you need to take that first step and commit to the process. If you found the video helpful, give it the thumbs up and subscribe to my channel, and click on the link below and find access to my free masterclass where I delve into even more detail. And there's a link somewhere around here for that. And you can find out how to work with me as well. Don't forget to subscribe and turn on notifications so you don't miss future videos. I'm sharing everything I've learned over the years to help you succeed in property investing. Thanks for watching, and I'll see you on the next one.